The more intelligent our machines become, the less intelligent our investing seems to get. Every day, headlines proclaim that artificial intelligence can now predict markets, analyze sentiment, and trade faster than any human ever could. Algorithms scan millions of data points in milliseconds, making buy and sell decisions without a moment's hesitation. It sounds like the dawn of a new age, one where reason finally defeats emotion and human error becomes obsolete. And yet, the results tell a different story. Despite all the data, processing power, and precision, investors continue to make the same mistakes Benjamin Graham warned about nearly a century ago: chasing trends, trusting forecasts, and mistaking movement for progress. The machines may be faster, but the minds guiding them are still driven by the same hopes and fears. In this video, we'll explore a question that sits at the heart of modern investing. Can artificial intelligence make us better investors or just faster speculators? Benjamin Graham, the father of value investing, lived through his own version of an AI revolution. His era had its own mechanical trading systems, formulas, and market illusions, all promising to remove uncertainty and all leading to the same conclusion, that no machine can protect us from ourselves. By the end of this video, you'll see why Graham's century-old warnings are not relics of the past, but roadmaps for the future. You'll learn what he understood about markets, emotion, and human judgment that no algorithm can replicate. Because in the race between man and machine, Graham would remind us, the true edge will always belong to the investor who can think independently, not the one who merely calculates faster. The early 20th century had its own fascination with systems that promised to outsmart the market. In Graham's time, they weren't called algorithms, they were called formulas, mechanical strategies, and scientific methods of speculation. But the promise was the same: to replace judgment with mathematics and thought with automation. After the crash of 1929, investors searched desperately for certainty. They wanted rules that could predict price movements, equations that could turn chaos into order. And Wall Street, always ready to sell confidence, obliged. Statistical trading systems, trend lines, and market timing models began to circulate, each claiming to eliminate risk through the power of logic. But Graham, ever the skeptic of easy answers, saw through it. He understood that numbers could illuminate, but they could also deceive. He wrote that the function of the margin of safety is in essence that of rendering unnecessary an accurate estimate of the future. In other words, the point of investing wisely was not to predict tomorrow, but to protect yourself from tomorrow. When markets rose, these mechanical systems looked brilliant. When they fell, they collapsed faster than their creators could comprehend. Every cycle reinforced the same truth: no formula could compensate for the frailty of human nature. Graham's own experience during the Great Depression taught him that the real enemy of sound investing wasn't ignorance, it was illusion. The illusion that the future could be known. The illusion that numbers could replace judgment. And the illusion that intelligence, whether human or artificial, could ever overcome emotion. Nearly a century later, we stand in a different kind of marketplace, one powered not by formulas, but by code. But the spirit is eerily familiar. Just as investors once worshipped the slide rule, they now revere the algorithm. And just as they once believed markets could be predicted through patterns, they now believe they can be conquered through data. But as Graham knew, the problem was never the tool, it was the temptation. The temptation to believe that certainty could be engineered, that the human element could be eliminated, that risk itself could be coded away.
And that temptation, Graham would say, is as dangerous today as it was in 1929. Benjamin Graham believed that the greatest error in investing was not misjudging the future, it was believing that the future could ever be judged with certainty. In his view, markets were not puzzles to be solved, they were reflections of human behavior, irrational, emotional, and cyclical. He often reminded his students that the stock market is there to serve you, not to instruct you. Its daily quotations, its fluctuations, its sudden moods, all of these were symptoms of psychology, not science. Trying to forecast them, Graham warned, was an exercise in illusion. He once wrote, "The future itself can be viewed only with uncertainty. The margin of safety is always dependent on an imperfect understanding of the world." That single sentence captures the essence of Graham's philosophy: humility before complexity. He accepted uncertainty as the natural state of markets. Rather than fighting it with prediction, he built defenses against it through valuation, patience, and discipline. To Graham, investing was not an act of prophecy, it was an act of protection. A rational investor did not try to know the unknowable, he prepared for it. He accepted that losses were inevitable, but ruin was optional. And that distinction, simple as it sounds, was the foundation of all enduring investment success. Yet human nature rebels against that idea. We crave control. We want to believe we can forecast, time, or outthink the crowd, because uncertainty feels like weakness. That desire has not changed. It has merely upgraded its tools. Where investors once relied on intuition, they now rely on machine learning. Where they once followed market experts, they now follow predictive models. But the underlying impulse to escape uncertainty remains exactly the same. Graham's insight was that this impulse is what turns intelligence into speculation. He understood that even the smartest minds, especially the smartest minds, are vulnerable to overconfidence when armed with elegant data and convincing logic. And that's why his philosophy endures. Because it wasn't built on the belief that humans can outthink the market. It was built on the recognition that they often can't. He would remind us that every investor, no matter how advanced his tools, must still answer the same timeless question. Am I acting on analysis, or am I seeking reassurance from prediction? That question, not a formula, not a model, remains the true test of intelligence in investing. Benjamin Graham did not try to predict the future. He prepared for it. His genius lay not in seeing what others couldn't, but in accepting what others wouldn't, that the future is unknowable, and therefore one must build a system that doesn't depend on foresight to survive. Graham's framework, valuation discipline, margin of safety, and emotional restraint was not designed to beat the market's next move. It was designed to withstand it. He believed every investment should be made with the understanding that one could be wrong about timing, about growth, about sentiment. That humility, built into the process, was what made the process timeless. In Security Analysis, Graham wrote, "The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future." It is a stunning idea, and one that modern investors often overlook. In a world obsessed with predictive precision, Graham's approach was founded on protective imperfection. He didn't seek perfect forecasts, he sought imperfect protection. He structured portfolios that could remain rational even when markets weren't. His method could be summarized as 3 quiet disciplines. First, insist on value over narrative. Graham valued businesses as they were, not as stories of what they might become. Intrinsic value was his anchor in a sea of changing expectations.
Second, demand a margin of safety. He treated every estimate as fallible and demanded a cushion between price and value wide enough to absorb human error and market surprise. Third, separate speculation from investment. To Graham, the investor's first task was self-knowledge, knowing whether one was acting as an owner or as a gambler. That clarity of purpose, not predictive power, defined sound investing. In Graham's world, the enemy was not volatility, it was vulnerability. He saw that most investors did not fail because the future turned against them, but because they built no defense for when it did. Today, that defense feels almost ancient in an era dominated by AI-driven forecasts and algorithmic trading signals. Yet, Graham would likely argue that while machines may process data faster, they cannot process doubt. And without doubt, there can be no margin of safety. He would caution that the investor who replaces judgment with automation may gain speed, but lose wisdom. Because in markets, the question is never merely how you decide, it's why. And the why of Graham's method was always simple, not to predict, but to endure. Nearly a century after The Intelligent Investor was written, the landscape of finance looks unrecognizable, and yet the psychology remains identical. Today's markets are ruled by algorithms that can execute trades in microseconds, scanning millions of data points across time zones and asset classes. Machine learning models forecast volatility, sentiment, and even the probability of a market crash. Artificial intelligence has turned what was once human intuition into code, a form of intelligence that never sleeps, never tires, never hesitates. But Benjamin Graham would not be impressed. He would be concerned. Because behind the sophistication of these systems lies a familiar illusion, the belief that precision equals safety, that with enough data one can eliminate uncertainty, that prediction, refined by technology, can replace judgment. Graham's warning echoes through time. The essence of investment management is the management of risks, not the management of returns. And that is where the modern investor stands most vulnerable. AI may process numbers flawlessly, but it cannot feel fear, greed, or overconfidence. Humans still can. And when humans build the systems, interpret their signals, and trust them blindly, emotion seeps back in, disguised as logic. We see this in flash crashes, in momentum-driven bubbles, in the eerie coordination of trades that amplify both euphoria and panic. Technology accelerates the rhythm, but the music is still the same. Graham would remind us that no algorithm can compute the value of patience. No neural network can measure the comfort of cash in a falling market. No predictive model can assign a confidence score to character, discipline, or temperament. In the AI era, what Graham taught becomes not obsolete, but essential. Because when machines make markets faster, human reason must become slower. When noise multiplies, clarity must deepen. When precision expands, humility must follow. He would likely view modern investors much as he viewed those of his own time, intelligent but restless, capable but overconfident, and forever tempted to mistake speed for progress. In the face of all this complexity, his advice would remain disarmingly simple. Value what endures, doubt what dazzles, and remember that the only prediction that truly matters is not about the market, it's about your own behavior within it. Benjamin Graham never saw a trading algorithm, but he understood its spiritual ancestor, the human impulse to mechanize certainty. From the ticker tape of the 1930s to today's AI dashboards glowing with data, the temptation has always been the same: to find a formula that frees us from doubt, to make investing feel less like judgment and more like engineering. But Graham knew that markets were not mechanical systems. They were mirrors. They reflected not logic, but emotion, not certainty, but cycles of fear and hope. And because those emotions are permanent, every age creates its own instruments of overconfidence. In his day, it was leverage and speculation. In ours, it's machine learning and quantitative trading. The danger is not the technology itself, it's what it awakens in us. The belief that we can bypass humility, that rationality can be outsourced, that wisdom can be coded. Yet wisdom, as Graham understood it, is not a product of calculation, it's a product of character. It grows from doubt, discipline, and detachment, from the willingness to be wrong and the patience to wait until being right matters. AI can simulate intelligence. It can even mimic judgment. But it cannot experience regret, and therefore it cannot learn the way investors must. Graham's philosophy was never about beating the market. It was about mastering the self. He saw the market not as an adversary to outsmart, but as a teacher to outlast. Every fluctuation, every bubble, every panic, a lesson in restraint and perspective. And that is why his warnings still matter today, because the greater the intelligence we build, the greater the humility we must keep. The moment we stop questioning our own certainty, whether human or artificial, we begin to speculate, not invest. In a world rushing toward automation, Graham's timeless question quietly endures. Are you managing your mind, or is the market, and now the machine, managing it for you? His philosophy reminds us that rational investing will always depend on something no algorithm can replicate: human reason disciplined by humility. If Benjamin Graham were alive today, surrounded by the speed and spectacle of AI-driven markets, he would likely say very little and watch very closely. Because beneath the layers of data, automation, and machine precision, he would recognize an ancient truth, that progress in tools does not guarantee progress in temperament. And that is where the modern investor's real test begins. When information moves faster than thought, Graham's discipline becomes a form of resistance. When predictions multiply, his principle of margin of safety becomes not just financial, but philosophical. It becomes a shield against the illusion of certainty that every new innovation brings. So what does it mean to apply Graham's framework in this AI age? It means returning to first principles, to insist that value is something measured by reality, not modeled by probability, to remember that price is a reflection of emotion, not truth, and to understand that the market's intelligence, no matter how artificial, will always be inferior to human patience. The intelligent investor of today is not the one with the fastest system, the largest data set, or the most powerful algorithm. It's the one who knows when to pause, when to let uncertainty breathe, and let reason speak quietly amid the noise. Because technology may evolve, but wisdom does not. Every generation must relearn what Graham taught in his own words. The investor's chief problem, and even his worst enemy, is likely to be himself. The challenge of our era is not to compete with machines, but to remain human, rational, patient, and grounded. To invest not with speed, but with sense. Not to predict, but to prepare. So as the world of finance moves ever faster, let us remember that the principles that endure are those that never needed speed to survive. Invest as Graham did, with humility, discipline, and faith in the simple truth that value, in the end, is not found in the algorithm, but in the mind that questions it. And if you found meaning in these reflections, subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.